Hello, I'm Gary Korolev with Sovereign Wealth Management. Today we'll discuss a few points around the market's reaction to Jay Powell's speech at Jackson Hole. And if you look at this quote, it's the most important part of his speech, arguably, and it's one of his shortest speeches recently, being 8 minutes. Well, the quote states, "To kill inflation, even if it means a sustained period of below-trend growth and softness in the labor market, as these are the unfortunate costs of reducing inflation." So what the Fed is telling us is even if we have a recession or a near recession, and if the labor market shows weakness or we have unemployment, they're still going to continue to tighten or at least not ease, which is what the market is used to in the past. So that's some pretty strong signaling that the Fed is not going to let the market scare them off easily. And what's interesting here, and you could say dangerous for the market, is unemployment is a lagging indicator. It's one of the most lagging indicators. So by the time unemployment starts showing a lot of weakness, that's usually when the Fed in the past has already started or has done a lot of easing and the market is already bottoming. So in this case, they're saying they're not even going to get close to start doing so, even if the labor market starts showing weakness. So this is the U.S. Conference Board index of leading indicators. So this looks about 6 months ahead and shows us what the state of the economy is. And of course, the markets follow the economy or try to get ahead of the economic conditions. And so you can see here, the blue line, anytime it goes below -5%, you're pretty much getting into a recession. These gray bars are when the recession happens. So this was the early 2000s, then we have 2008, the COVID crisis, and now we're back down to this area where historically a recession has started. And the Fed again is just telling us we're still not going to start loosening and start easing. One of the big reasons that you see here, this is the S&P 500, the US stock market, after having this pretty strong bear market rally into the end of the summer, has now started to correct back down. And so that's why we've been defensive in our portfolios. As you know, we've had a lot of bonds in our growth portfolios. And since the market has started pulling back in January, we've had a few of these bear market rallies. But as you can see, this trend line, this wide trend line, that trend is still intact, where it bounces up against the ceiling, another strong correction, and then we get another bounce, and now we've started another correction. So overall, it looks from a macro big picture perspective like it's smart to be defensive, at least from a technical standpoint, but also from a liquidity standpoint based on what the Fed is telling us. One of the few areas that seem to be fairly strong in the commodities / in the stock market is the energy sector, which has just been beaten up for the last 10 years, except if you look at the end of 2020 to now, we still show to be in a pretty strong uptrend, as you can see, whereas the bounces on the S&P 500 was the S&P hitting the ceiling and then bouncing down. Here you see a nice, strong, well-defined floor where, and this is XLE, this is the overall fund for the energy stocks in the S&P 500. You can see that bounces off this trend line and then continues upward, and we seem to be well in that trend right now. And this is just one of the few ways to gauge the health of a trend. And fundamentally, of course, we are having these shortages with the sanctions, with the conflict in Europe, and that's helping this trend stay strong despite the scares in terms of the recession and so on. So just a few points today. If you have any questions or would like more specifics, please contact us.